Hi everyone, welcome back to chapter 8. We're going to talk about the current liability. As on schedule, it shows that the current liability we're going to only use one class is because the current liability is actually not very complex, and as a matter of fact, a majority of stuff we have already talked about. For example, the deferred revenue and the payable. And I'm sure that you are not very unfamiliar with it. Hence that because I wanted to give you enough information for this class, and that I only scheduled one class for it. So the heavy lifting of the lecture is going to be conveyed in this recording. Hence, without further ado, let's start. I'm going to share my screen. Okay, so current liability is, as name stands, it's a liability that is gonna do within the operating cycle. So first of all, what is a liability? Liability has three essential characteristics. First of all, liability uh, means that it's gonna have a probable future sacrifice of the economic resource of the company. Second, it's arising from either present obligation to other entity or resulting from the past transactions or events, right? Um, and then you needed to remember that assets, on the other hand, actually representing the probable future benefit providing to company's operation, but a liability representing the probable means more than likely or definitely future sacrifices of the benefits. Okay, so what kind of benefits are going to be sacrificed here? First of all, most liabilities require the future sacrification of the cash, right? Such as we were paying the accounts payable by debiting accounts payable and crediting cash, right? We owing when paying our inventory, right? Or notes payable or salary payables. And then second, another kind of the sacrification, such as the deferred revenue, is requiring us to fulfill our fiduciary duty by providing services or inventory, right? Such as you book the games, like the customer bought the football games in advance, that the football stadium needs to make sure that they schedule the football games to earn that revenue that was already customer paid in advance, right? Or the gift cards, right? If you pay the Starbucks gift cards, then you pay cash or in that cards, hence that people need to the Starbucks employee providing you coffee. That's the moment that you have to recognize that revenue. Okay. Um, so um, we wanted to distinguish between the current liability and long-term liability. The current liability stands for durably payable in the 1 year from the balance sheet date, right? And the long-term liability is payable in more than 1 year from the balance sheet date. Okay, and so how do you? Why is the within 1 year? Does the 1 year always the golden number that we are used to differentiate between current liability versus long-term liability? Actually, the 1 year is actually not the finite definition about what is the long term. What is the finite definition between distinguishing between current and long term is actually the time it takes the firms to produce revenue. So in other words, if a company has an operating cycle that longer than 1 year, then the current liability are defined by the operating cycle rather than the length of a year. For example, if a winery usually takes more than 1 year or 2 years to generate wine that are able to sell, hence that to a winery, the current liability means the payable due more than 1 year. Okay? However, if a company have operating cycle less than 1 year, and then we classify the current liability that was due within 1 year as current. Okay, so if a company has an operating cycle for 15 months, then we classify current liability when those payable is due within 15 months. Okay. So with that being said, and then a lot of firms then consider what they would like to put on the balance sheet as current liability and what kind of item they would like to put on as a long-term liability. In normal sense, current liability actually representing demand of cash or demand of current assets. And that majority of the firms are less likely or less would like to put a lot of their liability as current liability because it's representing high risk, right? High default risk, high delinquency risk. So majority of them prefer to put on long-term side. So regarding what kind of items that can be considered as a current liability, there's several examples, and we're going to talk about each of them, right, in short period of time. So one we call the notes payable, which is interest-bearing promissory notes. Accounts payable usually is a short-term liability that owed to the vendors, suppliers, and payroll liability stands for the liability owed to employees or income statement, income tax liability. And deferred revenue is actually a little bit different from the liability we talked about above. It's actually the cash advances that come from customers or like or other entities that you need to fulfill the responsibility within a short period of time. And also, we wanted to talk about a sales tax payable. Why does a company need to report a sales tax payable, and how do we record it? And the last one is interesting enough is that the current portion of long-term debt has to also consider under the current liability for section of the balance sheet. Okay, so this is an example of Southwest Airlines, how current liability section of the Southwest Airlines balance sheet. As you can see, categorized accounts payable, accrued liability, and air traffic liability. And they also put the current maturity of long-term debt on their current liability section. Okay, so concept check. Which of the following typically considered as a current liability? Salary payable, yes. Prepaid insurance, this is assets, like current assets. Mortgage payable during 30 years is long-term liability. And accounts receivable, this is asset, and that we choose A. Okay, so now we wanted to introduce first the topics in terms of current liability, it's notes payable and interest expense. So notes, what is a note? Notes is signed by a firm promising to repay the amount borrowed plus interest, right? It's a formal debt contract between you and the borrower, or between you and the lender, that promising to pay not only the principal but also interest as well. So in order to calculate interest on the notes, we wanted to do following formula. First, we want to use the face value, multiple the annual interest rate, and multiple the fraction of the year that you loaned, that you borrow that money. Okay, so let's use Southwest as an example. Assume Southwest Airlines borrow 100,000 from Bank of America on September 1st, 2021, and signed about a 6% and 6 months note, right? So right now, I want to draw a timeline for us. So first of all, it's only 6 months, so that means it's gonna be doing. So first, it's gonna we want to draw December 31st 2021, because that's when you close the book, which is gonna be 3 months from here, right? And then the whole month is gonna be due on April 1st, 2022, right? Because this is another 3 months. Okay. So therefore, first we record the borrowing event, right? Which is the September 1st, 2021. We want to debit cash because you are borrowing 100,000 from Bank of America on that day. Bank of America deposit 100,000 cash into your bank account, and immediately generating a notes payable for 100,000. Okay, and we call this issue the notes payable. Okay, however, like I draw earlier, so December 31st is the date that you're gonna close the book. Hence, we wanted to accrue the interest that happens to these notes. And how much year-end adjustment entry for the interest payable that we talk about in chapter 3. So we're calculating the, first of all, the interest for the full term of the loan should be 100,000, multiple 6%, multiple 6 months out of 12, because you only borrow for 6 months. So the total, it should be only $3,000. However, from September 1st to December 31st is a 4 months already. Hence, we want to use the fraction of the year, which is 100,000 multiple 6%, multiple 4 dividing 12. And then we debit interest expense and credit interest payable for $2,000. And then when the date that we have to repay the loan, which is March 1st, 2022, we will debit notes payable for the whole amount. And then we want to record the debit of the interest expense only from January 1st to March 1st. And at the same time, we will debit the interest payable that we recorded and earlier as of December 31st, 2021, for that $2,000 that we already recognized as the interest expense earlier last year. And then we will credit in cash. This cash including principal of 100,000 plus interest of 3,000. So in other words, this 3,000 is that is split into two portions. One portion of $2,000 is coming from last year's recording of the interest payable, because as of December 31st, we should accrue the interest expenses already for $2,000 from September 1st to December 31st. And the second portion of this $3,000 is split into $1,000. That is means the interest expenses incurred from January 1st to March 1st. Okay. In summary, we would record interest expenses in the period we incur it rather than the period we pay for it, right? So when we pay for it, we essentially only pay it on March 1st, 2022. However, we're only generating from January 1st to March 1st, we're only generating expenses for only $1,000, and we accrued that interest expenses last year for the $2,000. Okay, let's do a quick example. So from October 1st, company signed a $10,000 5% 6 months note. How much interest would be recorded on December 31st of the same year? So let's first say how many months for the fraction of the year. So October 1st to December 31st, I said, so first you use the month minus the month, right? And then if it's actually from 1st to 31st, then you have to add in 1, because it's extra 1 more month. So it's 3 months, right? So therefore, we should to recording 3 months worth of interest of the notes. So the face value of 10,000 multiple 5%, right? And multiple 3 out of 12. And then it gives us $125 for choice B. Okay. Okay, and another form of accounts payable or short-term loan is actually called a line of credit or commercial paper. So line of credit is also the bank issued uh, uh, kind of short-term loan. It's an informal agreement. It permits the company to borrow up to a pre-arranged limits, right? So sometimes if your credit card also have a line of credits, say you can borrow up to 30,000, actually that's credit limit. If it's a talk about the bank, the companies, then you can understand the similar logic, like permits a company to borrow up to say $20,000 and doesn't need the formal customary note between the signature between the borrower and lender. And however, when you're recording the accounting transactions, you want to record exactly same as notes payable. And commercial papers actually meant borrowing from another company rather than the bank. And it's usually cheaper than borrowing from bank. And also it's sold with maturity ranging from 30 days to 270 days. Hence, it's less than 1 year, it should consider as a current liability. At the same time, the interest rate is usually lower than the bank, cheaper. So many short-term loans are arranged under an existing line of credits with the bank, and for larger corporations in the form of commercial papers, a loan from one company to another. And then we also mentioned about the accounts payable in prior lectures, such as amounts owed to the supplier of the merchandise or the services. Sometimes we call them trade accounts payable, right? Such as you buy the inventory, right? And on account, and you credit accounts payable, and you need to pay certain as to 10 and 60 or 30, right? So most accounts payable are current liability, but it could become a long-term liability if you actually cannot pay, or depending on the due date the vendor requires, right? So I want to also introduce you another very important portion of the current liability. We call it employer payroll liability. So first of all, let's look at what kind of payroll costs for employee and employer. For employee costs, first of all, employee pay federal and state income tax that's required by the law. At the same time, employer has need to withhold federal income tax or state income tax for employee. This is required by law. Hence, if you are working in the future, you will find that if your gross pay is $1,000, you probably only get a cash deposit into your bank about $600 at most. Okay, so now we are introduced to you, and later on when you get the paycheck, you'll not get shocked. So because employee needs to pay federal and state income tax, and also employee pay FICA costs, which is employee portion of a Social Security and Medicare. Okay, and also employee wanted to buy health insurance, dental insurance, disability, short-term disability, and life insurance as well. So that also taken from your paycheck. At the same time, employee can invest in retirement plans such as 401k or 3k or state retirement plan. Okay, so employer also incur payroll costs or payroll expenses as well. First of all, employer need to pay unemployment taxes to federal government and state government. And the employer also need matching the portion of Social Security and Medicare, about 7.65%, 7.65% for employees. So both employee and employer need to pay FICA taxes about 7.65%. One portion is coming from employee, another portion is coming from employer. So if the total adds up, it's about 15.3% contribution from the as long as you hire employee, right? So because 15.3%, one comes from employees paying for it, and the employer is paying for it as well. So a lot of people knows that FICA is 7.65% because we are employees. But some people, we don't know that employer is actually paying another 7.65% as well. And also employer also need to contribute to health, dental, disability, life insurances as well. If it's too expensive, sometimes employee only responsible for 50% of their costs. Employer contributes another 50%. Also, employer has the option to choose to contribute into employees' retirement and saving plans as well. So let's do more specific example. So federal and state income taxes for employees depending on your pay bracket, right? So for example, if you are paying above 100,000, it's pretty much 24%. And if lower than that, it's depending on which bracket you are making. Also, FICA taxes is actually, like I said, 7.65%, and Social Security is 6.2%, and 1.45 is actually Medicare taxes. And the Social Security only charge 6.2 up to $108,400. So, so if your pay is lower than 128,400, then you will 100% get taxed by 6.2% on that. But if your pay is more than 128,400, you are not subjecting the portion of it higher than 128,000 is not subjecting to 6.2% of the Social Security tax. In other words, there is a cap of paying the Social Security for 6.2%. The cap is 128,400 as of 2018. However, the Medicare taxes, there's no cap. So as long as you are making $1, you have to pay 1.45% of the Medicare taxes. And also, employee may also have additional amounts withheld from their paycheck for health insurance and dental insurance, disability and life insurance. And also, employee may also have to have a deduction from their paycheck for contributing retirement or employee saving plans, right? And the employer cost, as I just mentioned before, first of all, you have to additional matching the FICA tax on behalf of employee. As we talk about, it's a 7.65%, right? Matching. Employer has to pay 7.6% of FICA tax as well. And at the same time, employer also responsible for federal and state unemployment tax on behalf of employee. And the federal unemployment tax is about 0.8%, and the state unemployment tax is less or equal to 5.6. So it's add up about 6.2%, right? Totaled up of federal and the state unemployment tax. And then also, employer will also help the employee or fringe benefits pay for the health insurance or portion of health insurance costs, and dental and disability and life insurance. And also, employer can also choose to contribute to employee retirement and saving plans. Let's see this example. Hawaii Travel Agency has a total payroll for the month of January for $100,000 for 20 employees, and details are provided below. First of all, the travel agency help the employee withholding federal and state income tax for $24,000, and also health insurance premium Blue Cross paid by employer for $5,000. And then also travel agency contributed to employees retirement plan at Fidelity for $10,000. Same time, there's a FICA tax rate about 7.65% applied to Social Security and Medicare, and also federal and state unemployment taxes about 6.2%. So first of all, we record the employee salary expenses. We will debit expenses for $100,000, right, for 20 employees, and we will credit income tax payable for 24,000 withhold by employer for employee, right? So this is the federal income tax. And then we will withhold FICA tax payable for 7.6% for employee as well, right? So all this tax payable is that we as a travel agency, as a company, withhold from employee, and then later on to help employee to pay to the federal government, to help employee to pay to the Medicare and Social Security agency. And then what actually really left is salary really deposit to the employees' bank account is only 68,350. So all these income tax payable, FICA tax payable, and salary payable are all short-term loan, short-term liability. Okay, so let's look at the fringe benefit that employer provided, which is the contribution to the health plan and contribution to the retirement plan. So, and to record this transaction, employer will debit salary expenses for fringe benefits for 15,000 and credit accounts payable to Blue Cross Blue Shield and credit accounts payable for Fidelity for 10,000. Okay, now we wanted to record the employer's payroll taxes. That's the tax liability for employer, right? Which is gonna be the FICA taxes and 6.2 unemployment taxes. We will debit our payroll tax expenses total, and then we will credit the FICA tax payable and credit the unemployment tax payable for 6.2% for $100,000, and FICA also for 7.5%, and then we debit the payroll tax in total 13,850. So common mistakes made is that many people think that FICA taxes are paid only by employee for 7.6%. However, employer is also required to match the amount withheld for each employee, effectively doubling the amount paid to the Social Security. And employee salaries are reduced by withholding for federal and state income tax, FICA taxes, and employee portion of insurance and retirement contribution. Hence, that $100,000 of the payroll expenses, at the end, you only really deposit to the bank, which is the only way with pay cash about $68,250 by our example. And at the same time, employer too incurs additional payroll expenses such as unemployment taxes, right? Employer portion of FICA taxes, and the employer's insurance and retirement contribution as a fringe benefit. Okay, so let's do a concept check. Which of the following items are typically paid by employer only? A, federal and state income taxes on employees' wage. No, right? This is just withhold, or it's not paid by the employer. It's help to withhold from employee. Essentially, it's employees paying for it. B, Social Security taxes. Okay, that's only, right? This question is the following items are only paid by employer only. Social Security taxes is actually paid by both employee and employer, right? No, not B. B, federal and state unemployment tax. Yes, this is the only paid by employer. And Medicare tax, same as the Social Security, it's paid by both employer and employee. Okay, Companies are required by law to withhold federal and state income taxes from employees' paycheck. Employers are also required to withhold Social Security and Medicare taxes from employees' paycheck. In addition, employer might withhold optional deductions such as medical insurance, premium contribution to retirement program, and other fringe benefits. Unemployment tax are not withheld because they are paid solely by employees. So, and then we wanted to look at the deferred revenue, it's other form of current liability. So what is the deferred revenue? I don't think we are not familiar with, we are pretty familiar, but we wanted to redefine here. Deferred revenue occurs when a company receives cash in advance and then it debits to cash and credits to deferred revenue as a current liability, right? For example, Apple sells iPhone gift card to a customer for $100. So you will debit cash and credit deferred revenue. Also, when the customer purchases and downloading the songs, say for $15 worth of music, Apple will record the following transaction by reducing the liability and recognize the revenue, right? By debiting a deferred revenue, crediting sales revenue. Okay, so let's look at the revenue recognition policy of United Airlines as an example. The revenue recognition policy says that the company reported passengers' ticket sales and tickets sold by other airlines for use of United as a passenger's revenue when the transportation is provided. All you're saying here is that deferred revenue is actually liability in essence because the cash advance is actually paid by the customer is not recognized as revenue until the services or product is provided. Hence, the value of unused passenger ticket is included in the current liability section as advance ticket sales. In other words, deferred revenue is very common, pervasive in the airline industry. And another interesting current liability we want to talk about is sales tax. Remember, every time we buy anything, we will have the selling price, say $100, and end up we have a sales tax, right? $6, and then we end up paying $1.106.50, and this sales tax is collected by the seller, right? Hence, the seller also have a fiduciary duty to collect or withhold sales tax for the customer. And once a while, the sales tax needed to submit it back to the state or local government. So when this happens, how do we record in the transactions? So specifically in some states, companies are required to collecting the sales tax when selling goods and services, and then remitting those taxes back to the state and local government. The collection of cash from the customer to creating a liability for the company. Hence, assume that you buy lunch at the airport for $15 plus 10% of sales tax. The airport restaurant will record the following journal entry. They will debit the cash for $16.550 that you gave to the restaurant, and they credit sales revenue for $15 and credit sales tax payable for $1.50. The sales tax collected from customers by the seller are not an expense, okay? But it is a liability payable to the government. The last interesting current liability we want to introduce is that the current portion of long-term debt is also considered as a current liability. In other words, debt will be paid within next year is considered as current liability. For example, a 20-year mortgage can be split and reported as a portion that are due within next year, considered as a current liability, and after next year, considered as long-term liability. So long-term obligations are reclassified and reported as a current liability when they become payable with upcoming year. For example, a note payable that matures in 10 years is reported as a long-term liability for only the first 9 years, but the but as a current liability on its 10th year. So let's look at the Southwest again as an example. The current liability portion, remember, there is a current maturity of long-term debt for $506 million. And the long-term debt less than current maturity is reporting as $2,821,000. Okay, so let's look at this example. A home improvement store sells some merchandise to a customer. The price of merchandise is $200 and sales tax rate is 6.5. How much would the reported sales tax payable? It would be 200 multiplied by 6.5, that would be $13, right? So sales tax payable is only reporting the tax portion, right? It's not including the sales amount. Hence, choose A. Okay, I just summarize what we actually introduced here. We just talk about the current liability, right? And we talk about notes payable, and we talk about the payroll taxes payable, and how to record employee and employer portion, right? And then we talk about deferred revenue, and we talk about the sales tax, and we talk about the current portion of long-term debt. And all these are the items that belong to current liability. And we have already very familiar with this, and we did a lot of exercise in terms of note payable, interest payable. And then also the things are new to us is employee and employer payroll taxes and sales taxes. And the current portion of long-term debt is a reclassification problem. And I think in general, current liability is a pretty relatively easy topic. And the next portion of this chapter, I want to focus on contingent. And I will see you in the next portion. Thank you very much.